It's been a rough year for buyers in the housing market. Following 3 straight summers of absurd price growth, many believed that the crash was finally here after the Case-Shiller showed a peak in prices last June. For 7 straight months, the market flashed red, with median prices declining at a pace worse than 2006. Many speculated that this was the beginning of the end. The new crash was starting, and the pain for buyers was being passed up to the sellers. But just as one side of the market rejoiced, the new year shocked everyone. Despite record high interest rates, the Case-Shiller flattened out, and once again the market went back to its outrageous behavior. Open houses in the spring were incredibly busy, multiple offers were common, and absurd evaluations became the norm once again. For all of you looking to buy, you're probably watching this video wondering if this clearly insane bubble will ever end. And surprisingly, new evidence has surfaced in the past week that shows a couple of shocking developments. And it starts with this: inventory. You see, if you're looking at the housing market through the lens of simple math, what you see is essentially 2 variables: supply and demand. That may sound extremely simplistic, but at the end of the day, the entire market rests on this basic foundational principle. And right now, everyone knows demand is just not there. If you look at what is traditionally the best proxy to measure housing demand, what you see is a disaster. This is the Mortgage Application Index, and for decades, it's been a reliable form of evidence to showcase demand for single-family homes. In the past year, this index has fallen to lows we haven't seen since the '08 crash, and even if you look away from this at various other measurements of demand, you'll quickly see that the story aligns. Demand is weak when you compare it to years past, but for some reason, prices and competition still remain extremely high. And this is because purchase applications are no longer a proxy for today's demand due to the fact that supply, the other side of the equation, is extremely low. What we have today is a supply-constrained market. There is no recovery in demand. It's just that there are so few houses on the market that despite record low demand, we are seeing a strong floor emerge in the market where the sheer tightness has created an illusion of a strong foundation. Demand figures are essentially giving false indications, and previous estimates based on these figures are no longer reliable in this new low supply world. Simply put, inventory is just not increasing at a pace we should be seeing. The story comes down to new listings, which are falling behind at concerning rates. Nobody in the United States is looking to sell their home, given the fact that most are living in houses that have appreciated more than 30% in the last 3 years, and they're usually sitting on 30-year mortgages that have rates well below 4%, sometimes as low as 2.6%. Now look around at today's rates and prices, and you start to see why everyone that bought a home before 2020 is essentially locked in for the foreseeable future. Sure, it is true that when you look at year-over-year statistics, the situation may not be as bad as it seems. For example, this past week, we saw a 2% rise in inventory levels compared to last year. And if you look at pure numbers, we technically have 44% more homes in the market compared to 2022, but as Mike Simonson of Altos Research explains, this isn't really the narrative that should be focused on. What we have to understand is that in 2022, we were coming off all-time lows in inventory numbers, so the year-over-year figures are a bit biased when comparing them to last year. For example, sure, we have 44% more homes this year, but last year we had 75% more homes compared to 2021. This means that the rate of growth in inventory is slowing down severely. His estimate says that by the end of the year, we will end 2023 with around 500,000 single-family homes, an improvement when compared to years past, but still well below pre-2020 numbers. And going back to that simple principle of supply and demand, it's very hard for prices to decline if this kind of supply situation continues. So with that said, you might be considering leaving this video and clicking on another one with your hopes of price declines shattered. If this summer looks like a wash and the crash is not happening this year, then when will we see relief in this crazy market? Well, there is hope, but before we go over that, I hope you can take 10 seconds of your time and hit that like and subscribe button if you're enjoying the content thus far. Every single thumbs up is a signal to the algorithm that you're enjoying the content, and I hope you can take a moment to help the channel out. Now back to what I was saying about timing the crash. We know that if Mike's prediction is true and supply ends the year around 500,000, the chances of significant price declines are slim to none. So how do we get there? Well, in my opinion, the only way is for this guy to continue his fight against inflation, which means rate hikes that exceed market expectations. Essentially, the Fed has already killed demand by pushing rates up to levels we haven't seen in years, but despite this, a crazy thing has occurred. Delinquencies or bankruptcies were at record lows. Imagine that. Despite despite the fact that the median payment for a house is more than 2 times higher than 2019, the number of people struggling to make payments is at a record low. So Powell needs to continue with his hikes, and while the market expects him to pause soon, the housing market isn't going to get much better if that truly is the case. Like I just said, bankruptcies are at a record low, and while it may not seem this way by observing media headlines, the typical homeowner today looks very healthy from a financial perspective. This means houses that were normally available due to distressed buyers have seemingly disappeared from the market. Combine that with the fact that no normal person wants to sell, and you have a recipe for a supply disaster. Now, the way to change this is to continue tightening and eventually raise the unemployment rate. The unfortunate fact about this market is that Powell needs to raise the unemployment rate before we see any significant relief for buyers. If this situation continues, then sadly, real estate prices are not going anywhere. Buyers have proven that even in the face of 7% mortgages, they will continue to buy the few houses that come to market. Essentially, what I'm saying is that you really can't have a housing crash without a recession, and that is sort of a double-edged sword. To hope for a housing crash is to hope that your neighbor loses his job while you keep yours. And the unfortunate reality is that we seem to be headed towards a recession. Nearly every expert expects significant headwinds in the near future for every business sector in America. Even if we ignore the experts and look strictly at indicators like treasury spreads, you can see that the future does not look bright. Treasury spreads have clearly been proven to be reliable in the past, and today they show that the US has a 68% chance of entering economic turmoil. And by looking at an even more specific one, the situation looks even more grim. One of the Fed's favorite indicators, the 13-18 forward, which looks at the yield spread between the 3-month Treasury and the 18-month Treasury, shows a 94% chance of economic turmoil. This is the highest reading in decades. If you look at the red boxes, this indicator has previously shot up prior to major drawdowns. This includes the months prior to the dot-com crash, the year prior to the 2008 recession, and the months prior to the 2020 crash. At levels up here, we are clearly flirting with extreme danger. Today we find ourselves in what can only be described as a transitory period within the housing market. We have seen a bubble develop in the post-2020 world, and now, despite unemployment being at record lows, demand has fallen off a cliff. Prices are not dropping yet, but they are flat following 36 months of insane growth. This indicates that the slope is evening out, and if for any reason these recession projections turn out to be correct, we have a situation that could end up looking like 2008. Right now, because of these unique factors, supply is essentially holding the entire market up. But if we do indeed see a recession within the next year and unemployment begins to tick up, everything that has made the housing market so resilient for the past 10 years will look different. At the end of the day, what we need to look out for can be seen with these charts provided by Altos Research, which shows sales and supply. You see, for the past few months, as supply has increased, sales have followed, which shows clearly that the balance is still in favor of the sellers. Every time inventory increases, sales match the pace. The second we see inventory rise while sales fail to rise with it is the second we know that the market is really turning. It's only at this moment where we can finally declare that this bubble is dead. After which, we will be able to spot the last phase of the crash, which will come in the form of significant increases in price declines. So far, price declines have remained relatively calm when compared to last year, which shows that the market continues to remain somewhat imbalanced despite these large demand drops. Once this indicator begins to trend up is when the true panic selling begins, and the downfall of the market will only then look apparent. Thank you guys for watching. If you would like a more in-depth look into inventory numbers, please take a moment and head to Altos Research YouTube page where they go over the data in much more detail. Like I mentioned earlier, don't forget to like and subscribe to this channel if you've enjoyed it, and drop a comment below letting me know what you think of this recent inventory development.